Hello, everyone. This is Mohammad Akif with Akif CPA. I am a Texas CPA, also a chartered accountant in Ontario. And today we'll be discussing reporting of Canadian assets on the U.S. tax return. This is one of the areas which is most troubled for Canadians when they come to U.S. to work or they are thinking about moving to U.S. So I do want to, before we get into details, I want to give one tip, a very important tip. I just got on a call with another prospect client too, and then I'll tell you a story about that as well. So technically, when so this tip is for Canadians who have moved to U.S. or Canadians who are thinking about moving to U.S. This is your first year tax return that you're filing for, and then this is a tip for them, for Canadians who have moved. This is your first year of filing, or who are thinking of filing or moving into to US for any reason. That please do not file the tax return on your own. And then I'll tell you why. Because first of all, I mean, the U.S. tax system is much different than the Canadians. We do have foreign reporting requirements. They're not similar to the Canadian side. So I've seen a lot of misinformation, incomplete information, information that was reported incorrectly. That also includes missed tax treaty elections. And these are very important elections, between U.S. and Canada for tax treaty purposes, regarding your RRSP accounts, fair market value when you move, the TFSAs. There are just too many of them to be missed, and then this is very important. I can give you a case study. Recently, I got off the call with a prospect client who's been in the U.S. for the last 3 years, moved in 3 to 4 years, moved in 2021, uh, and earned income from U.S., earned income from Canada, and has been doing the same thing, and then has not reported, just did not know about foreign reporting. Reported the U.S. income on the U.S. side, Canadian income on the Canadian side, trying to maintain resident. I'm not. There's just too many things happening, and then now has missed FBAR reporting for last 3 years. Has missed other reporting. The TFSA has accounts. They're just so many things. So it's my advice, my recommendation is to, for the first year, get someone, to help you. Get someone to help you with the U.S. Canadian filings. A person who, or company, or a firm who does both sides. See what they have done for you. See, and then from there on, learn from it, and maybe you can try the second year. But the first year, it is going to be complicated. It is going to be messy. You need help. I cannot stress enough. I had a client a couple years back who has been in the U.S. for the last 10 years, did not file a bar, just didn't know about it. And now, of course, the penalties on the U.S. side is so humongous, 50% of the account value. This is a lot of money for a lot of people. So I will recommend paying someone. And think of it as an investment that you're trying to save yourself from all the headache and the hassles that will come in the future. Pay somebody to do your taxes, to understand them, learn from them. If you can, doing them the second year yourself. And I'm sure by the time you will have more information, you will know what needs to be filed, so you can take care of it. If not, of course, you can find somebody else to do it for you. But make sure the first year you need help. You get somebody to do it for you. I know a lot of Canadians are DIY people, want to do yourself. I do get it. It gets expensive, but at the same time, the headache is not worth it. The stress is not worth it. So that will be my 2 cents. Make sure that when you move the first time to US, you get help to do your tax returns, so you can understand what needs to be done on the Canadian side and also US side, and then how to manage it properly moving forward. So without any further ado, so let's get into reporting of Canadian assets on the US tax return. So let's tell the assets that I'm talking about are bank accounts, retirement accounts such as RSP, LIRA, LIRA, RDSP, TFSA, non-registered accounts, which are trading accounts, education savings account could be RSP, rental properties, Canadian rental properties, Canadian mutual funds, Canadian ETFs, and shares of Canadian corporations. These are majority of the Canadian assets that normally are owned by a person who's moving to the United States. And then, so how do we report these Canadian assets on the U.S. tax return? So first of all, before I get started, I do want to point out that there's a form on the U.S. side which is Schedule B. That this form needs to be filled out if you do have more than 10,000 in any of these accounts combined. That Schedule B form is very important. I've seen a lot of Canadians with that form missed too, where they didn't report that they had foreign accounts, bank accounts that need to be reported. So this is just one form. It's an information form. It's two, three questions, and then just ask you if you meet the threshold. And, if you do, what country did you file, and that stuff. And then there are trust questions. So make sure that you fill out the Schedule B Part 2 form. That's what I'm referring to. So now let's get into details. So there are two main forms that we will be discussing today. The one form is the IRS form 8938, and the other form is 114, which is a FinCEN. Both are separate forms that has assets being reported on them. So 8938 form, the IRS form, is more complex in reporting, requires more information to be filed versus a FinCEN 114 form. So, these are two of the main forms. I will get into detail. I do want to get the small ones out of the way. So let's say, for example, if you have Canadian rental properties, they do go on Schedule E. We do have a different depreciation method for foreign rental properties. If you have PFICs, which is passive foreign investment companies, corporations, this is Form 8621. I'll get into a little bit of detail of PFIC too. And then, of course, if you own shares of a Canadian corporation that is not publicly listed, that needs to be reported on Form 5471. So let's get into the 8938 and 114 form. IRS has a wonderful page about this. I don't normally like their instructions, but this one form, they have done a great job where they can share information about 8938 FBAR filing requirements. So the idea is that we're reporting the value of the assets. That's what we are reporting. FBAR does have different threshold, and then the 8938 has a different threshold. So it's not the cost, it's the value of the assets that we are reporting on each form, which is 8938 versus FBAR. So I'll share the link in the description of this video, but I want to share this. I do want to share go with you on the website with the on the page to make sure that we are on the same page and we're looking at this. So I'll share this page on the screen. You can see myself, and then you can see the screen too. So this is a IRS comparison of 8938 versus FBAR. What it tells you is who needs to file the form. Of course, these are U.S. persons. So U.S. person could be U.S. citizens, residents, alien. This could be any person who is not as long as they meet the threshold, they do become U.S. tax residents. So these are all the person who must file this form. So these forms are also applicable to the entities. So right now we're only talking about individuals. So let's go to reporting threshold of 8938. So if you are living in the U.S. and you are unmarried, so technically single, the total value of the asset was more than 50,000 on the last day of the tax year, or more than 75,000 at any time. This is the value of the assets. I'm not talking about the cost here. I'm talking about the value of the assets. Then the assets must be reported on 8938. If you were married filing jointly, so this is married filing jointly returns. So if you're married filing separately, this will be this is the area that the threshold that you need to be looking at. So if you're filing jointly, the value of the assets was more than 100,000 on the last day of the tax year, or more than 150,000 at any time during the year. So that's if you meet the threshold, that's where you need to report in N38. Versus, let's move into the FBAR. So the reason I want to talk about living in the U.S. is because we're talking about Canadians who are in the U.S. So I'm not going to any individuals who are living outside. So let's go to the FBAR. FBAR has a much lower threshold than the 8938. Has much more low reporting requirements than 8938. So for FBAR, the amount should exceed 10,000 in aggregate. So that means if you have 5 different accounts and then the value of the accounts on July 14 crossed the 10,000 threshold, FBAR is applicable to you. So in cases, there could be cases where only FBAR is applicable to you and not the 8938, because you might have more than 10,000 but less than 50,000, or 75,000 anytime. Or, that could be the case if filing jointly, you have a much higher threshold. So if you could have more than 10,000 and 100,000 and 150,000 at any time during the year. So in majority of cases, FBAR will be more applicable than applicable than 8938. So let's say people who are doing tax planning before moving, of course, they will know this threshold, will be winding down, making, cross-border taxation much simpler for them. The first year, of course, is going to be complex, but FBAR in majority of cases will be applicable. So again, 10,000 in aggregate value. That means if you 5 different accounts, 2,500, 1,500 here and there, and everything combined on July 14, an example crosses the 10,000, then FBAR is applicable to you. We will report all the foreign accounts on those. And then so what do I mean by foreign accounts? Of course, this is retirement accounts, the RRSP. These are your TFSA accounts. This is your security accounts. These are not rental properties and are not 5471. So this is that's a separate one. But if you do have bank accounts with the corporation, then that goes on the FBAR as well. So these are the information that needs to be reported. These are the threshold. It's a great page. I really like this. Otherwise, IRS they're not good at putting instructions out. Their instructions are much more complex than the CRA. I believe the CRA does a better job in providing information and than the IRS. So what is reported is the maximum value of the foreign assets. So that's very important. This is on the FBAR. Let's say for your child, if you are a signature authority, that also needs to be taken care of, because that is still, you still have the signature authority on the account. That needs to be reported as well. So make sure that you do understand. We do have certain reporting requirements on each of them that are separate. For details, of course, you can reach out to us. We can help you if you do need help. But in real terms, I mean, FBAR will be applicable to most of the people when they're moving to the US versus 8938. 8938 is more complex in reporting, especially when it comes to RSPs, and then these accounts. I do want to point out I do want to discuss the mutual funds, the US mutual funds, and then how the US looks at the Canadian mutual funds or Canadian ETFs versus how the CRS. So of course, majority of times when you are in Canada, when you open TFSA accounts or RSP accounts, the majority of the investment will be into mutual funds, Canadian mutual funds and Canadian ETFs. That is okay. But in case of a TFSA, that is not okay on the US side. The reason is that because first of all, there is no guidelines for a TFSA account on the US side. Secondly, majority of the Canadian mutual funds and the Canadian ETFs, they don't follow the same reporting requirements of the US. So they're considered passive foreign investment corporations for US tax purposes. And then what do I mean by that is that, even though the TFSA, it is sort of like a retirement account, like a Roth IRA on the US side, but the investments in those accounts do matter. So let's say if you have GIC, that is okay. If you have shares, that is okay. But if you do have Canadian mutual funds, Canadian ETFs, we need to report them separately on Form 8621, which is a PFIC form. So there is a separate calculation that goes into it. So even though if it's a PFSA account, it's non-taxable account. Once you withdraw or any earning that you have is all tax-free. Well, on the US side, that is not the case. US will tax you on the earnings in the TFSA. That could be through GIC, could be through capital gains, could be through the mutual funds or ETFs. These are all taxable in the US. Not taxable in Canada, but taxable in the US. So when you are planning to move, make sure you do tax planning. Make sure you reach out to someone, a cross-border specialist that can help you simplify before you move, because it's very important. These are all the accounts that you might have, you might not have, but they can play a bigger role on the US side. Majority of times, of course, when we are moving for economic purposes, to get a better job, make more investments. There are other things. So we want to make sure that you take advantage of the tax rates, the the tax side of the things when you do move. So it's just not about making most of the money. It's also about trying to keep the most money, and then through tax planning to making sure that we simplify a lot of the things before we move. So these are the forms that are required on the US side. Of course, let's go back to the forms. We will use Schedule B, Part 2, to report the FBARs reporting for the foreign accounts. We will report the foreign assets on 8938. We will also report if it's more than 10,000 on the FinCEN Form 114, which goes to the Treasury Department. It's a different department than the IRS. We will report the rental properties on Schedule E. Of course, we will have a different depreciation rate for those properties than the US. The Canadian mutual funds and ETFs are reported on 8621, and again, shares of the Canadian corporation that you own while you are a U.S. resident are reported on 5471. 5471 is a beast in terms of reporting. I would stay away from it as far as possible. If you cannot escape it, then make sure you do planning and you do understand how the 5471 impacts you, because it is a beast of forms. And then I'm not kidding. Is something that if you can avoid even the mutual funds and the ETFs. Any questions? The email is on the description. The phone number, the contact numbers are on the description. You can reach out to us, and then we can help you.